Welcome to the most important financial lesson you'll ever learn. If you're serious about investing, you need to understand stock valuation. Not the complicated stuff that Wall Street uses to confuse regular people, but the one fundamental formula that actually matters. The formula that lets you determine if a stock is cheap or expensive. The formula that separates smart investors from everyone else. If you want to subscribe to the channel for more investing fundamentals broken down simply, now's a great time to hit that button. Let's start with the basics. Every stock has a price. You see it on your phone, your broker's website, or your financial apps. But here's what most people don't realize. Price and value are completely different things. Price is what you pay. Value is what you get. You could buy a stock for $50 that's actually worth $30. Or you could buy a stock for $20 that's worth $80. Understanding the difference between price and value is literally the foundation of intelligent investing. So how do you calculate value? Well, that's where our formula comes in. It's called the present value of future cash flows. Now, I know that sounds intimidating, but stick with me because I'm going to break it down into pieces you can actually use. The core idea is this. A stock is worth the sum of all the money it will make for you in the future, discounted back to today's dollars. Think about it this way. If I told you a company would pay you $100 next year, how much is that worth to you today? Well, it's worth less than $100 because you have to wait a year. You could take $90 today and invest it somewhere else and earn returns. So that $100 tomorrow might be worth $90 today. That's called discounting. The formula looks like this. Value equals the expected cash flows divided by 1 plus the discount rate, raised to the power of the number of years, summed across all future years. But here's the beautiful part. For most stocks, you don't need to calculate infinitely into the future. You can use a shortcut that professional investors use every single day. It's called the dividend discount model, or the free cash flow to equity model. For dividends, the formula is even simpler. It's the expected next dividend divided by the required rate of return minus the growth rate. Let me give you an example with real numbers. Say a company pays a $2 annual dividend today. You expect dividends to grow at 5% per year forever, and you want a 10% annual return on your stock investments. A value would be $2 times 1.05, divided by 0.10 minus 0.05. That's $2.10, divided by 0.05. So, if the stock is trading at $35, it's undervalued. You'd want to buy it. If it's trading at $50, it's overvalued. You'd want to avoid it or sell it if you own it. This is how you actually pick stocks, not by following hot tips from Twitter, not by watching CNBC and reacting to what talking heads say, but by doing the math. Now let me show you how to gather the numbers you need. First, you need the expected future cash flows. For dividend stocks, this is easy. You go to your brokerage, you look at the historical dividend, and you assume it continues. Many companies have paid and raised dividends for decades. General Mills, Procter & Gamble, Johnson & Johnson. These are incredibly stable. You can reasonably project their dividends forward. But here's the thing, not all stocks pay dividends. So for growth companies, you use free cash flow instead. Free cash flow is the cash a company generates after it spends money on operations and capital expenditures. You can find this on any financial statement. It's operating cash flow minus capital expenditures. Companies like Apple, Microsoft, and Google generate enormous amounts of free cash flow, even if they don't pay dividends. Second, you need to estimate the growth rate. This is where being realistic matters. If a company has grown earnings at 15% for the last decade, it's reasonable to assume it might continue at 12% going forward. But don't assume it grows forever. At some point, every company matures. You might assume higher growth for 10 years, then lower growth after that. Wall Street analysts publish growth estimates you can use as a starting point, but always apply your own judgment. Third, you need to determine your required rate of return. This is your discount rate. It depends on how risky you think the stock is. A safe, stable utility company might have a required return of 8%. An exciting tech startup might require 15 or 20%. Think of it as the minimum return you need to justify owning that particular stock, instead of keeping your money in treasuries or other investments. Here's where this gets really valuable. Once you have these three inputs, you can run the numbers. And more importantly, you can see how sensitive your valuation is to changes in these assumptions. If a stock seems incredibly valuable only if it grows 20% forever, but the company has never grown faster than 8%, that's a red flag. you're betting on unrealistic assumptions. Many professional investors use spreadsheets to test multiple scenarios. They calculate a base case, an optimistic case, and a pessimistic case. For the base case, they use their best estimates. For the optimistic case, they assume higher growth and lower discount rates. For the pessimistic case, the opposite. This gives them a range of possible values. Then they only buy if the stock price is below even the pessimistic valuation. This approach is conservative. It protects you from overpaying. And if you like this kind of practical investing wisdom, please hit the like button. These insights take serious research to uncover, and it helps us create more content like this. Now, let me address the most common objection people have to this approach. They say, but the market is irrational. Stocks don't trade at their true value. And you know what? They're right. In the short term, stocks can trade way above or below their intrinsic value. Fear and greed move prices more than fundamentals sometimes. That's actually good news for you. It means there are opportunities to buy stocks at a discount or sell them at a premium. The key is time horizon. If you're trading in and out every week, valuation matters less than momentum and technical patterns. But if you're investing for the long term, which you should be, valuation is everything. Because over 5, 10, 20-year periods, stock prices converge toward their intrinsic value. The market gets it right eventually. Patient investors who buy undervalued stocks make enormous wealth. Suppose you're looking at a real estate investment trust that pays a 4% dividend. Historical dividends have grown at 3% annually. You require a 9% return because REITs are somewhat volatile. The calculation is $4 times 1.03 divided by 0.09 minus 0.03. That's $4.12 divided by 0.06, which equals $68.67. If the REIT is trading at $55, you found a bargain. You might buy a meaningful position. If it's trading at $80, you pass. You wait for a better opportunity. And trust me, in markets, better opportunities always come. That's the power of disciplined valuation. You're not trying to predict the future. You're not trying to time the market. You're simply identifying when prices diverge from value and letting time do the work. Here's something else that's crucial. This formula works for any cash-producing asset, not just stocks. Real estate, private businesses, bonds. Anything that throws off cash can be valued using this method. Warren Buffett uses variations of this formula to evaluate every investment he makes. Charlie Munger uses it. Every serious investor uses it because it works. The beautiful thing is that you don't need to be a math genius. You don't need a finance degree. You don't need access to proprietary databases or expensive research. Everything you need is publicly available. Free financial statements, historical data, analyst estimates, all online. You just need to spend an hour learning how to plug numbers into a spreadsheet. And once you do, you'll think about stocks completely differently. You'll look at a stock trading at $100, and instead of seeing a $100 price tag, you'll see a number on a spreadsheet. You'll ask yourself, is this worth $100 based on cash flows and growth and risk? Often the answer is no, and that discipline is how you build real wealth in the stock market. So let's review the formula one more time. For dividend stocks, next year's dividend times the growth rate plus 1 divided by your required return minus the growth rate. For free cash flow stocks, you do the same calculation but use expected free cash flow instead of dividends. The inputs are straightforward: historical cash flows or dividends, reasonable growth rate assumptions, and your personally required rate of return. Then you run scenarios: base case, optimistic, pessimistic. You look at the range of values, and you only invest when the stock price is significantly below your most conservative valuation. We're talking at least a 20 to 30% margin of safety. That margin protects you from errors in your assumptions. And errors happen. The future is uncertain. That's why you demand a margin of safety. This approach has one more advantage that most people don't talk about. It forces discipline. It prevents you from buying hot stocks that everyone is talking about. It prevents you from buying based on emotion. Because at the end of the day, valuation doesn't care about sentiment. It doesn't care about news cycles or what's trending on social media. It just shows you the math. And the math is cold and honest. Now you might be thinking this sounds like a lot of work. And it is, compared to just randomly picking stocks. But it's actually less work than most people do. Most people spend hours watching financial news, hours reading financial Twitter, hours talking to friends about their stock picks. This method takes maybe 2 hours per stock to really understand the numbers. And those 2 hours can make or break your investment returns. In closing, remember this: There is one fundamental formula that matters in stock investing: the present value of future cash flows, divided by your required rate of return. Everything else is noise. Does the company have a great CEO? Possibly, but that affects growth rates and cash flows, which you can measure. Is the industry growing? Good. That affects your growth assumptions. Are interest rates rising? That might affect your discount rate. But all of it feeds into this one formula. Master this, and you've mastered stock picking. I'd love to hear from you in the comments below. Have you ever calculated the intrinsic value of a stock before? Or is this your first time learning about this formula? Let me know your experience with valuation, and we can discuss it down there. And if you found this valuable, subscribe to the channel. We break down complex investing concepts into simple, actionable lessons every single week. Thanks for watching, and I'll see you in the next video.